Horace Mann just posted their highest earnings in company history.
Oh, yeah. Oh, record break.
I mean, we are talking a massive 39% jump in earnings per share year over year.
Right.
It's the kind of quarter that, usually has Wall Street throwing an absolute parade.
You'd expect champagne in the boardroom.
Exactly. And yet the very first thing management does on the earnings call is basically beg investors to look the other way.
It's wild.
They introduced an entire presentation slide solely dedicated to talking down their own record profits.
It is honestly the ultimate paradox of the public markets. You spend your entire corporate existence trying to maximize profit, you finally hit a home run, and your immediate reaction is to tell everyone it doesn't count.
Welcome to Talk Tickers, where we bring you data-forward, actionable breakdowns of corporate earnings.
Keeping it real for the retail investor.
Always. So today's mission for this deep dive is Horace Mann Educators Corporation, ticker symbol, HMN.
It's a fascinating one.
It really is, because it gets to the very core of how retail investors can be completely misled if they only look at the headline numbers.
Which happens all the time.
All the time.
Yeah.
So we are going to unpack their Q4 and full year 2025 earnings call. We'll figure out why management is running from their own success rate.
Yeah, that's the big question.
And we'll give you a definitive, opinionated stance on whether this stock actually deserves a place in your portfolio.
Because, look, in the property and casualty insurance business, a massive profit isn't always evidence of a brilliant strategy.
Sometimes you just get lucky.
Exactly. Sometimes you just get incredibly lucky with the weather.
Yeah.
And trying to parse out what is structural genius versus what is just, a really mild winter is the entire game.
So let's start right there with the conflict between those headline numbers and the reality on the ground.
Let's do it.
Because I was digging through the segment breakdowns in the transcript.
Yeah.
And the raw data is just staggering for a mature niche financial stock.
The growth numbers were huge.
Right. Full year 2025 core earnings per share hit $4.71.
It's a huge beat.
And total core earnings reached $196 million. Their shareholder return on equity, the ROE, is sitting at 12.4%.
Which is very solid for an insurer.
And the sales growth is what really caught my eye, honestly. Like individual supplemental sales jumped nearly 40%.
Yeah, 40% is massive.
Group benefits soared 33%.
And don't forget the core engine of the business, too.
The P&C side.
Right. Their property and casualty combined ratio improved by over 8 points, landing at 89.7.
Yeah, I want to highlight that because to put that 89.7 combined ratio in perspective, that means for every dollar Horace Mann takes in through premiums, they are paying out less than 90 cents in claims and expenses.
Just a cash machine at that level.
They are pocketing a dime of pure underwriting profit on every dollar before they even touch the investment income.
Right, before the float even does any work.
Exactly. And improving that metric by 8 full points in a single year, that is a massive leap.
Unheard of, really.
But here's where I have to push back on the narrative. I see a $4.71 EPS, and the CFO, Ryan Grenier, immediately steps in and says, please normalize this down to 3.95 cents.
Yeah, he just undercuts his own victory.
He literally tells the analyst community to subtract 76 cents from the earnings card to establish a true baseline.
Yep.
Why? I mean, why would you intentionally amputate 16% of your own earnings in front of Wall Street?
Well, it really comes down to the concept of the earnings treadmill.
The treadmill, right?
If you are a publicly traded company, your valuation is basically a multiple of your predictable recurring cash flow.
Predictable being the key word.
Exactly. The market pays a premium for certainty. So if management allows Wall Street to price the stock based on a freakishly good year driven by anomalies, they are setting themselves up for a brutal punishment the following year.
Those anomalies inevitably disappear.
Right. Wall Street will look at the year-over-year decline and assume the business model is failing, even if it's just, reverting to the mean.
So it's expectation management on steroids.
Basically, yeah.
They are trying to dictate the baseline so they don't get punished for missing an impossible comp next year.
Exactly. By normalizing the earnings down to $3.95, management is establishing a baseline that they actually control.
Ah, I see.
They are isolating the core operational engine of the business. They want investors to judge them on the $3.95 is because they know they can predictably grow that specific number.
But they can't predictably grow the $4.71.
No, absolutely not. Because they don't control the weather.
Which brings us to the obvious question. What exactly is inside that 76-cent gap?
A lot of luck, honestly.
Right. If $3.95 is the engine, what was the rocket fuel that pushed them to $4.71?
Well, let's unpack the story behind those numbers. Because the biggest culprit here, like we said, the ultimate uncontrollable variable was the weather.
Mother Nature.
The insurance business is entirely at the mercy of Mother Nature. When Horace Mann prices a homeowner's policy or an auto policy, they build a certain expectation of catastrophe into the premium.
They have to, yeah.
They use decades of actuarial data to estimate, how many hurricanes will hit the coast, how many hailstorms will tear through the Midwest, how many wildfires will break out.
But the climate doesn't always read the actuarial tables, does it?
Rarely.
The transcript from this call highlights that severe weather in 2025 was unusually light.
Unusually light is an understatement.
Right. Horace Mann's pre-tax catastrophe losses, the CLAT losses, were only $62 million for the entire year.
And $62 million is remarkably low for a company with their exposure.
Wow.
The CFO specifically pointed out that these catastrophe losses were more than one standard deviation below their historic modeled averages.
So it's just a statistical outlier.
Exactly. They priced their policies assuming a much higher level of destruction. Because the weather was so mild, they simply didn't have to write the checks they expected to write.
And that stroke of luck alone added roughly $28 million to their bottom line.
Yep.
Which translates to about 55 cents per share in earnings that they absolutely had not planned for.
It's just free money.
So right off the bat, 55 cents of that 76-cent adjustment is just Mother Nature taking a vacation.
And you can't put a mild winter in a discounted cash flow model.
You really can't. And if you try, the market will eventually humble you.
Oh, the market always humbles you.
But there was a second major factor in that 76-cent adjustment. And it's a concept that trips up a lot of retail investors.
Favorable prior year reserve development.
Yeah. Favorable prior year reserve development. It sounds like something buried in a 400-page accounting textbook.
It does sound incredibly boring.
It does. But it's a massive lever in the insurance industry. Essentially, this is a multi-million-dollar rainy day fund that turned out to be too big, right?
That is a great way to look at it.
Can you break that down for us?
Sure. When an insurance company receives a claim, say a complex multi-car accident with injuries, they don't instantly know the final price tag.
Right, because things drag out.
Exactly. Medical bills roll in over time. Litigation can drag on for years. Supply chain issues might inflate the cost of car parts.
Yeah, getting parts right now is a nightmare anyway.
Right. So because of this uncertainty, the company sets aside a chunk of capital, a reserve, based on their most conservative estimate of what that claim will ultimately cost.
So they are basically holding cash hostage on their balance sheet just in case the worst case scenario materializes.
Precisely. They incur the expense on their income statement the moment they set the reserve, even though the cash hasn't fully gone out the door yet.
Okay, that makes sense.
Now, what happened here in 2025 is that Horace Mann's actuaries looked back at the reserves they established for claims from 2023 and 2024.
The oldest stuff.
Yeah. As those older claims finally settled and closed out, they realized their initial estimates were too pessimistic.
They overestimated the damage.
Right. Maybe the litigation settled out of court for less, or the medical treatments were less extensive than feared.
And because they didn't need all the cash they had set aside, accounting rules allow them to release that excess money back into the current year's profit column.
Exactly. It just flows right back.
And in 2025, that favorable development amounted to $19 million.
$19 million of pure bottom line profit, just dropping out of the sky simply because they were overly cautious in the past.
That's a huge boost.
It is. But here's the critical distinction for you evaluating this stock. Management removes this from the normalized earnings because it is a backward-looking one-time benefit.
Right. You can't run a sustainable business model by chronically overestimating your costs and then cheering when you find the money 3 years later.
No, Wall Street sees right through that.
I noticed during the Q&A portion of the earnings call, an analyst from BMO Capital Markets, Jack Martin, pressed the CFO on this exact point.
He did.
He wanted to know how much reserve development they were baking into their future targets.
And Ryan Grenier's answer was textbook discipline.
What did he say?
He stated unequivocally, "We do not include any prior year development, favorable or adverse, in our planning assumptions."
Wow. So they just zeroed it out.
Yep. They recognize the $19 million windfall today, but they demand that Wall Street values the company assuming that windfall drops to zero tomorrow.
It makes perfect sense. If we go back to a sports analogy, it's like a baseball team that trained perfectly and hit a ton of home runs.
Right.
But they also had the wind blowing out to center field all season long, and the umpire was giving them a massive strike zone.
A perfect storm of good luck.
Exactly. If you are a shareholder taking home that $4.71 EPS, you celebrate, you cash the check.
Oh, absolutely.
But if you are betting on the team's performance next season, you don't bet on the wind and the umpire showing up again. You bet on the batter's underlying swing.
I like that framing. The entire point of the $3.95 normalized baseline is to isolate the swing.
Strip away the noise.
We have to strip away the weather, strip away the reserve releases, and ask, is the fundamental business actually operating efficiently?
And when we do that, the data from this call suggests this wasn't just a lucky year. It was a highly fortunate year stacked on top of a structurally sound operational year.
Yes. The core engine is humming.
Let's pivot and examine that underlying operation. Because if you strip away the anomalies, you need a compelling reason to own the stock.
You do. You need a growth thesis.
And for Horace Mann, the thesis rests entirely on their demographic focus.
Which is very unique.
They are not a generic spray and pray insurance company blanketing the airwaves with mascot commercials, trying to sell auto policies to everyone.
No geckos or emus here.
No geckos. They have cornered a hyper-specific niche, K-12 educators, teachers, administrators, school staff.
And from a risk management perspective, K-12 educators are arguably one of the most attractive demographic cohorts in the entire country.
Why is that? I mean, a car crash is a car crash, whether a teacher's driving or a software engineer's driving.
Well, yes and no.
What makes this niche so structurally profitable?
It comes down to behavioral predictability and risk aversion.
Okay.
The actuarial data on educators is fascinating. As a group, they tend to be highly responsible.
Makes sense, given the profession.
Right. They drive predictable, familiar routes to and from school during standard hours, which lowers accident frequency.
So they aren't out joyriding at 2 a.m.
Exactly. They value long-term stability, which means they rarely jump from insurer to insurer chasing a $5 discount.
They just set it and forget it.
And their employment is highly insulated from macroeconomic recessions. Like, schools don't generally do mass layoffs when the stock market dips.
That's true. So they are incredibly sticky customers with a lower than average risk profile and high job security.
It's the holy grail for an insurance underwriter.
But the challenge has never really been the profitability of the educator demographic, right?
No. Everyone knows teachers are good risks.
The challenge has always been acquiring them in a crowded market.
Exactly, getting their attention.
And this is where Horace Mann's 2025 operational execution really shines. The CEO, Rita Zaraidis, revealed a statistic on this call that is frankly hard to believe.
The brand awareness number?
Yes. She noted that their unaided brand awareness among educators leaped from less than 10% a year ago to 35% in 2025.
It's almost unbelievable.
Let's pause on that because that is a staggering metric. Unaided brand awareness means if you walk into a teacher's lounge and ask, name a financial services company, 35% of them are now naming Horace Mann without any prompting or multiple choice options.
From under 10% to 35%?
Going from under 10% to 35% in 12 months is practically unheard of without a Super Bowl ad budget.
And Horace Mann isn't running Super Bowl ads.
Exactly. So how did they buy that kind of mind share? I highly doubt they just spam teachers with direct mail.
No, direct mail wouldn't move the needle like that. They achieved it through a highly targeted ecosystem strategy.
What does that look like?
Well, instead of marketing at teachers, they embedded themselves into the brands and platforms that teachers already trust and rely on.
Strategic alignment.
The transcript details 2 key partnerships. The first is with Crayola.
Crayola, the crayon company. It sounds almost too simple, but it makes perfect sense. Every elementary school teacher in America interacts with that brand.
It's brilliant by association. You borrow Crayola's goodwill.
Wow.
But the second partnership is even more impactful. They partnered with an organization called Get Your Teach On, which provides professional development, conferences, and resources for educators.
Right. The CEO mentioned that the Get Your Teach On partnership gives them deep engagement with an audience of over 800,000 educators.
That's a massive captive audience.
They are reaching them through email newsletters, social media channels, and physical presence at live educational events.
They are meeting their target demographic where they are already actively trying to improve their careers.
This strategy must dramatically lower their customer acquisition cost.
Oh, significantly.
Okay.
Instead of fighting a bidding war on Google search terms for cheap auto insurance, which is insanely expensive.
Right. You're competing with the giants there.
Exactly. Instead of doing that, they are generating warm, high-trust leads through professional development networks.
And we see the proof of concept in the distribution metrics from the call.
The agency numbers were great.
Their agency force, the actual representatives on the ground, grew by 15% in a single year.
That's huge for a mature company.
Furthermore, they aggressively upgraded their digital quoting tools, resulting in website traffic and online originated quotes more than doubling over the course of 2025.
So the top of the funnel is just overflowing.
And all of that top of funnel activity cascaded into what I consider the most important single data point in the entire earnings call.
The household growth.
Yes. It didn't even make the main prepared remarks. It slipped out during a Q&A exchange with Matt Carletti, an analyst from Citizens.
Analysts always find the hidden gems.
He noticed a subtle shift on one of the presentation slides regarding household penetration. Management confirmed that they expanded their reach from 1 million educator households to 1.1 million educator households.
That is 100,000 net new households brought into the Horace Mann ecosystem in 12 months.
A 10% expansion of their total addressable footprint.
Incredible.
But let me play devil's advocate here for a second. Go for it. Adding 100,000 households is great top-line growth, right?
Okay.
But if they just sold 100,000 loss-leading bare-bones renters insurance policies, does that actually move the needle for the stock?
That's a fair point.
I mean, is there a risk they are buying unprofitable market share just to pad the household number for Wall Street?
That is exactly the right question to ask, and it really gets to the core of their lifetime value strategy.
How so?
The CEO addressed this directly. When Horace Mann acquires a new household, even if it's through a very small, low-margin product, like a basic supplemental health plan or a small life insurance policy, that customer is now inside the walled garden.
They've established the initial billing relationship and the data profile.
Precisely. Because educators are so sticky, as we discussed, Horace Mann now has a captive audience of 1.1 million households to cross-sell to over a span of decades.
Right. The teacher you bring in today with a basic retirement account is the same teacher who 3 years from now needs auto insurance for a new car.
Or homeowners insurance when they move to a better school district.
Exactly. By expanding the base by 100,000 households, they've massively increased their future cross-sell pipeline without having to pay a second acquisition cost.
The cross-sell multiplier effect. It makes perfect sense.
So we have the top-line growth humming along, but revenue growth is utterly meaningless if your underlying costs are spiraling out of control.
Growth without margin is just charity.
Exactly. Let's look at the expense side of the ledger, because the CFO detailed a very aggressive, multi-pronged approach to optimizing their efficiency.
They aren't just selling more, they are actively trimming the fat.
The insurance industry has historically been plagued by bloat, hasn't it?
Oh, absolutely. Legacy technology, massive administrative overhead, paper-heavy processing. It's a dinosaur industry in a lot of ways.
Management at Horace Mann recognized that to defend their margins, they had to modernize the back office.
And they made some big moves in 2025.
The transcript outlines several structural actions they took, starting with the termination of a legacy pension plan.
Getting a defined benefit pension plan off the books is a huge de-risking move.
It really is.
It removes a massive, unpredictable liability tied to the stock market and interest rates and transitions that risk away from the shareholders.
But the tech initiative is what really stood out to me. They talked extensively about their rollout of straight-through processing and automation.
STP, it's a game changer.
For the listener who doesn't spend their days deep in insurance tech, what exactly is straight-through processing, and why is it so hard for a legacy company to implement?
Straight-through processing, or STP, is the holy grail of underwriting efficiency.
Okay.
In the old model, if a teacher applied for auto insurance, that application generated a physical file.
Like actual paper.
Or a digital equivalent that still needed human eyes. A human underwriter had to open the file, manually pull motor vehicle records, check credit scores, run the actuarial guidelines, and physically approve or deny the policy.
It took time, and human labor is incredibly expensive.
Plus the margin for human error, inconsistent pricing, all of that. Exactly. Straight-through processing replaces that human bottleneck with algorithmic logic.
How does that look in practice?
A customer fills out an online application. The system uses APIs to instantly pull all third-party data. The pricing algorithm scores the risk in milliseconds, and the policy is issued and bound without a single human employee ever touching the application.
Wow. It sounds incredibly efficient, but it also sounds terrifying from a risk standpoint.
It can be.
If the algorithm is flawed, couldn't a company accidentally write thousands of highly unprofitable policies in a matter of hours?
That is exactly why legacy insurers have been so slow to adopt it.
They're scared of the machine.
They are. It requires an immense amount of confidence in your data and your pricing models. The fact that Horace Mann is aggressively rolling out STP indicates that their actuarial models for the K-12 demographic are highly refined.
They trust the data enough to let the machine make the decisions.
And the cost savings are immediate.
But the savings weren't just limited to technology either.
No, they made human capital moves too.
Late in 2025, they pulled a classic corporate restructuring lever, an early retirement program.
A tried and true method to cut overhead.
An analyst from Piper Sandler, John Barnidge, asked about the uptake on this program.
And the CEO clarified that they strictly targeted this offer, right?
Yeah, she said only about 8% of the employee base met the age and tenure requirements to even be eligible. But she noted they got a pretty nice participation rate.
The strategic intent behind an early retirement package is twofold.
Walk us through that.
First, it allows older, often higher salaried employees who are nearing the end of their careers to exit gracefully with a financial cushion.
Which is good for morale.
Right. But financially, this immediately strips out layers of legacy compensation from the payroll.
And second,
it allows a company to reallocate that headcount capital. The CEO explicitly stated they are using a portion of those salary savings to hire new talent with specific skill sets needed for a digital-first future.
Data scientists, digital marketing experts, automation engineers.
Exactly. They are swapping legacy administrative overhead for digital growth drivers.
And the remaining savings drop straight to the bottom line.
Pure profit.
The CFO quantified the net result of all these actions. They have generated over $10 million in permanent annualized run rate savings.
That's incredible.
That is $10 million every single year going forward that Horace Mann no longer has to spend to keep the lights on.
When you synthesize all of this, the $10 million in cost savings, the 100,000 new households, the explosive brand awareness growth, it validates the entire premise of the $3.95 normalized EPS.
It proves it wasn't just a fluke.
Right. The core engine is not just sound, it is gaining market share and operating more efficiently.
Which perfectly transitions us into looking ahead. Management established the $3.95 baseline. Now, what are they promising to do with it?
Let's look at the guidance.
Let's unpack the 2026 management guidance. They laid out a core EPS projection for 2026 between $4.20 and $4.50.
And here is where the psychological game of normalization pays off for the investor who is actually paying attention.
This is crucial.
If you are a retail investor just glancing at a stock screener, you see that Horace Mann earned $4.71 in 2025, and they are guiding to a midpoint of $4.35 for 2026.
It looks like a terrible year-over-year decline.
It looks like earnings are shrinking by nearly 8%.
Exactly. The headline optics are incredibly negative.
But because management spent the entire call walking the analysts through the weather anomalies and establishing the true $3.95 line,
that $4.20 to $4.50 target is revealed for what it actually is.
Okay.
A highly credible, solid 10% growth rate.
They are projecting a 10% compound annual growth rate in core earnings, completely stripping out any reliance on good weather.
A 10% growth rate in a boring, mature insurance sector is fantastic.
It really is.
But to trust that 10%, we need to dissect the underlying assumptions. Management gave specific guidance on the levers that will get them to that $4.20-$4.50 range.
Let's dig into the levers.
Let's start with the big variable, catastrophe losses. How are they modeling the weather for 2026, considering they just got away with a miraculously low $62 million in 2025?
They are modeling a harsh return to reality.
Okay, what are the numbers?
The CFO stated they are assuming catastrophe losses will jump back up to a normal $90 million run rate for 2026.
Wow. So they are proactively building a $28 million headwind into their own guidance.
Yes. They are assuming Mother Nature brings the hammer down.
That's a very cautious approach.
Precisely. Ryan Grenier acknowledged the reality of their business. Predicting specific catastrophe losses is impossible.
You can't predict a hurricane a year out.
No, but they utilize a blend of third-party, industry-standard catastrophe models overlaid with Horace Mann's specific historic footprint to arrive at that $90 million figure.
So it's not just a guess.
No, it is a conservative, mathematically sound approach. They are not banking on lightning striking twice with another quiet storm season.
Okay, so the weather assumption is conservative. Let's look at the second major guidance metric. Net investment income, or NII?
The float.
Yes, they're projecting NII to land between $485 million and $495 million for 2026.
Which is a massive chunk of their profit.
Let's break down the mechanics of NII, because for a lot of investors, they think an insurance company makes all its money by collecting more in premiums than it pays out in claims.
That's the common misconception.
But the real wealth generation happens in the float, right?
Yeah, absolutely. The concept of float is the secret engine of the insurance industry. Warren Buffett built an empire on it.
Right. When a teacher pays their annual auto insurance premium in January, Horace Mann doesn't just put that cash in a checking account and wait to see if the teacher crashes their car in November.
That would be a waste of capital.
They take that massive tool of collective premium dollars and invest it.
They get to hold and earn yield on billions of dollars of other people's money before the claims come due.
And because insurance payouts are somewhat predictable in the aggregate, they heavily favor highly liquid, stable investments.
Bonds, mostly.
The transcript notes their core fixed income portfolio is yielding a very healthy 5.51%.
Which is great. They're benefiting from the fact that interest rates have remained relatively elevated.
Right, allowing them to reinvest maturing bonds into higher yielding new money instruments.
However, there was a specific drag on their investment portfolio that management felt compelled to highlight.
I noticed that.
And this is exactly the kind of nuance retail investors need to monitor. The CFO specifically called out one piece of their alternative investment portfolio: a commercial mortgage loan fund managed by Soundmark Partners.
He noted the fund is in runoff.
Yes, runoff.
I want to clarify that term. What does it mean for a commercial real estate fund to be in runoff, and why is it dragging down Horace Mann's returns?
Well, when an investment fund goes into runoff, it means the fund is essentially closed for business.
Okay.
They are no longer accepting new capital, and they are no longer making new investments.
So what are they doing?
The fund managers are simply trying to manage the existing portfolio of commercial mortgages, collect the payments, sell off the underlying properties when possible, and slowly return the original capital to the investors over a period of years.
It's a managed liquidation.
Exactly. And as we know, the commercial real estate sector, particularly office buildings and certain retail segments, has been under immense pressure.
High interest rates, remote work.
Yeah, shifting work habits. The CFO expects continued underperformance and lower yields from this specific Soundmark fund as it liquidates.
So it will act as a slight anchor on their overall commercial mortgage yields in 2026.
Yes.
But the key context here is containment. The CFO assured the analyst community that this issue is idiosyncratic.
Meaning it is isolated strictly to this one specific fund.
Right, and not indicative of a rot spreading through their broader $6 billion investment portfolio.
And more importantly, the expected drag from this runoff fund is already fully baked into that $485 to $495 million NII guidance.
We aren't hiding it, they are quantifying it.
Transparency builds trust.
And that trust extends to the third key metric in their 2026 guidance: the expense ratio.
We already discussed the $10 million in cost savings from technology and early retirements.
Now, management is committing to a long-term trajectory. They are targeting a 100 to 150 basis point reduction in their expense ratio over the next 3 years.
Starting with a planned 25 basis point drop in 2026.
To put that in plain language, they expect to spend 1% to 1.5% less to run the business relative to the premiums they bring in.
That's huge leverage.
When you are managing billions of dollars in premium revenue, pulling a full percent out of your administrative overhead drops massive, compounding amounts of cash directly to the bottom line.
It creates immense operating leverage. As they scale to 1.2 or 1.3 million households, the incremental cost of servicing each new policy goes down.
Meaning profit margins expand even faster than revenue.
Exactly.
Now, I want to transition to what I found to be the most fascinating and arguably the most crucial strategic move discussed on the entire call.
Oh, I know what you're going to say.
It involves their reinsurance strategy.
Yes.
The CFO mentioned that their total spending on reinsurance, the actual dollar amount they paid, stayed completely flat year over year.
Unchanged.
Yet, somehow, they secured an additional $240 million in coverage.
It's a magic trick.
How does an insurer walk away with $250 million in extra catastrophic protection without their bill going up? And why does this matter so much for the retail investor considering this stock?
This is really a masterclass in corporate risk management and capital allocation.
Walk us through it.
To understand the genius of this move, you have to visualize how reinsurance works. Think of reinsurance literally as insurance for the insurance company.
Right.
If a massive historic hurricane hits Florida and levels entire neighborhoods, Horace Mann cannot afford to pay thousands of total loss claims out of their own cash reserves without risking insolvency.
They go bankrupt.
So they buy reinsurance policies to transfer that extreme risk off their balance sheet.
The reinsurers agree to step in and foot the bill once the total cost of a disaster reaches a specific threshold.
Right. In the industry, that threshold is called an attachment point.
An attachment point.
You can think of it exactly like a massive deductible. For Horace Mann, their core catastrophe attachment point is $35 million.
Okay, so if a Midwestern hailstorm causes $20 million in damage, Horace Mann pays every penny.
Exactly. But if a massive hurricane causes $100 million in damage, Horace Mann pays the first $35 million, and the global reinsurance market pays the remaining $65 million.
So visualize this reinsurance coverage as a vertical tower of risk.
Yes, the tower. The bottom levels of the tower, the coverage sitting right above that $35 million deductible, are highly likely to be triggered by moderate seasonal storms.
So it's riskier for the reinsurer.
Because the risk of the reinsurer having to pay out is high, that specific tier of coverage is incredibly expensive for Horace Mann to buy.
Makes sense. Conversely, the very top of the tower, the coverage designed only for a once-in-a-century superstorm, is theoretically much less likely to be triggered.
Making it cheaper per dollar of coverage.
So what exactly happened in the market going into 2026 that allowed them to manipulate this tower?
The global reinsurance market experienced a softening.
What does that mean?
After a few years of really high rates, capital flooded back into the reinsurance sector, increasing supply. As a result, the overall cost to buy coverage went down.
Simple supply and demand.
Right. Horace Mann's team negotiated a 17% reduction in their rate online, which is the actual price tag for the coverage they buy.
Now, if I am a short-term oriented CEO trying to juice my quarterly bonus,
Oh, I know you do.
I take that 17% savings, I drop it straight to the bottom line as profit,
Ew.
and I celebrate the massive margin expansion on the next earnings call.
Exactly. The temptation to pocket the savings is huge. But Horace Mann didn't do that.
They didn't.
No. Instead, they took every dollar of that 17% savings, went back to the reinsurance market, and bought an extra $240 million of coverage at the very top of their tower.
Wow.
They extended their protection against the absolute worst case scenario.
But why the urgency to extend the top of the tower? Were they just being overly paranoid?
It wasn't paranoia, it was data-driven prudence.
Carlos.
The CFO noted that a major third-party catastrophe modeling firm, AIR, had recently updated their global climate and risk models.
Yeah.
These updated models suggested that the frequency and severity of extreme weather events, the tail risks, might actually be rising.
Ah, so the math changed.
Horace Mann's actuaries looked at the updated AIR data, looked at the softening reinsurance pricing, and decided the most responsible use of shareholder capital was to fortify the balance sheet.
So their overall budget for reinsurance didn't increase by a single cent.
Not a penny.
They spent the exact same dollar amount as last year, but because of market timing and strategic capital deployment, they walked away with a $240 million safety net against a historic natural disaster.
It is the ultimate defensive maneuver. It places a concrete ceiling on their downside risk.
If 2026 brings an unprecedented string of hurricanes or historic wildfires, Horace Mann's financial foundation is bulletproof.
For a retail investor whose primary concern should be capital preservation, this proves that the executive team is actively protecting the downside.
Not just chasing top-line vanity metrics.
Exactly.
Which brings us to the final segment of Talk Tickers. The bottom line.
The verdict.
This is where we synthesize the operational data, the management guidance, and the risk strategy to take a definitive, actionable stance.
Drum roll, please.
Based on everything we've unpacked, the normalization of earnings, the explosive 100,000 household demographic growth, the aggressive expense optimization, and that brilliant reinsurance maneuver, our stance on Horace Mann is definitively bullish.
Unapologetically bullish.
If you are constructing a diversified portfolio, Horace Mann is a textbook example of a durable, cash-generating asset.
It lacks the speculative glamour of an artificial intelligence startup, sure.
It's not NVIDIA.
Right. But it offers a fundamentally sound niche monopoly that is executing its long-term strategy with precision.
We want to leave you with 3 highly actionable takeaways to consider as you evaluate this stock for your own portfolio.
Actionable takeaway number 1. The underlying growth engine is highly credible and deeply diversified.
Management's 10% earnings per share growth target for 2026 is not a hope and pray forecast.
No, it's credible because it isn't reliant on a single exhaustible lever.
Right. A lazy insurance company tries to hit 10% growth simply by jacking up the premium rates on their existing auto customers year after year.
That is a toxic strategy that eventually drives the customer straight to a competitor.
Horace Mann's growth is driven by structural expansion.
They grew their agency force by 15%.
They physically brought 100,000 net new households into the ecosystem.
And most importantly, their high-margin non-auto segments are exploding.
Individual supplemental health sales are up 40%. Life insurance sales are up 21%.
They are successfully cross-selling a suite of financial wellness products to a captive, highly loyal demographic of educators.
When you control 35% of the unaided brand awareness in a specific professional niche, you possess a moat that a generic national competitor simply cannot replicate without spending billions.
Actionable takeaway number 2. This management team is aggressively and consistently shareholder-friendly.
They understand that returning capital to the owners is a primary function of a mature business.
We haven't even talked about the share buybacks yet, and they are massive.
The transcript highlights that Horace Mann spent $21 million repurchasing their own stock on the open market in 2025.
And they clearly believe the stock is undervalued right now.
Because they didn't take their foot off the gas in the new year. Through just the month of January 2026, they had already scooped up another $6 million worth of shares.
And they still have a staggering $49 million authorized by the board and left in the chamber to deploy.
For a retail investor, aggressive share buybacks provide 2 massive benefits.
Let's break those down.
First, it is mathematical alchemy. By buying and retiring shares, the company reduces the total number of shares outstanding.
Right. That means next year's profit is divided by a smaller pool of ownership.
Which artificially boosts the earnings per share and theoretically the stock price without the company actually having to sell a single extra policy.
It's a beautiful thing. And second, a $49 million buyback authorization acts as a massive concrete floor under the stock price.
How so?
Well, if the broader market panics over some macroeconomic fear and Horace Mann's stock drops 10%.
Management is sitting there with $49 million in cash, ready to aggressively buy up those artificially cheap shares.
Exactly. That constant institutional buying pressure halts the slide and protects your downside.
The CFO specifically stated their free cash flow conversion rate is targeted at north of 75%.
This underlying business generates an immense amount of free cash, and they are funneling it directly back into the stock.
But that brings us to actionable takeaway number 3. And this is perhaps the most vital warning for anyone listening who relies on digital tools to research stocks.
You must avoid the valuation screener trap.
I see retail investors fall for this constantly.
It's so easy to do.
Let's walk through exactly how the screener trap works with Horace Mann. If you log into your brokerage account right now or load up Yahoo Finance and type in ticker HMN, the automated algorithm is going to pull the GAAP financial data.
It is going to calculate a trailing price-to-earnings ratio based on that unadjusted, wildly inflated $4.71 record EPS.
Because the algorithm lacks context.
Right. It doesn't read the earnings transcripts.
It doesn't know that $1.55 of that earnings came from a freakishly mild winter, or that $19 million came from a one-time reserve release.
The algorithm is just going to divide the current stock price by $4.71, and it is going to spit out a PE multiple that makes Horace Mann look like a screaming generational value buy.
It is going to look incredibly cheap, but it's a mirage.
You are valuing the stock assuming the wind blows out to center field forever.
You must manually override the algorithm. You have to price this stock based on the normalized 3.95 cents baseline, growing at 10% to management's target of roughly $4.35 for 2026.
You have to evaluate the valuation based on what the underlying core engine can actually produce under normal modeled weather conditions.
If you run the PE ratio using that $4.35 forward estimate, and you still find the valuation attractive relative to their 10% growth rate and their massive dividend and buyback yield,
then it is a fundamentally sound investment.
But you have to do the manual math to clear out the noise.
Yeah.
That is the essence of fundamental analysis. You can't rely on the headline numbers.
To summarize the entire Horace Mann thesis, they posted an absolute blockbuster year in 2025, heavily assisted by light weather and legacy reserve releases.
But when you strip away the anomalies and the luck, You uncover an underlying operational engine that is firing on all cylinders.
They are achieving monopolistic dominance within the K-12 educator niche.
They are aggressively slashing legacy administrative expenses.
And they have laid out a highly credible, data-backed path to a 10% core earnings growth rate in 2026, all while insulating the balance sheet with a $240 million reinsurance safety net.
It is a masterclass in operational focus and expectation management.
Truly.
Before we wrap up this deep dive, we want to leave you with a final provocative thought, something to mull over and apply to your broader investment strategy.
This deep dive revealed how Horace Mann is essentially building a compounding wealth machine by cornering a hyper-specific, homogeneous professional demographic.
They aren't trying to be the generic insurance provider for 330 million Americans.
No, they are acting as the specialized, bespoke, one-stop shop for the financial wellness of just K-12 teachers.
Which raises a crucial structural question for your own portfolio research. What other hyper-specific professional niches are out there hiding in plain sight?
Think about the demographics that share unified behavioral traits and financial needs.
Like traveling nurses who need flexible multi-state coverage.
Or municipal utility workers with highly specific pension structures.
Or independent tradespeople and freelance creative professionals who lack traditional corporate HR safety nets.
These are massive, homogeneous populations generating trillions in economic value.
And many of them are currently being vastly underserved by the big, generic, one-size-fits-all Wall Street banking giants.
The question you have to ask yourself as an investor is, what other under-the-radar, boring companies are out there right now, quietly building impregnable monopolies inside those forgotten demographics?
Find the company that is doing for traveling nurses what Horace Mann has done for teachers, and you might just find your next great long-term investment.
Keep questioning the headlines, keep doing the manual math, and keep digging into the data.
Thanks for joining us on this deep dive. See you next time.